Hello, I'm Aaron Johnson with the Dwayne Johnson Group at Bridger Financial Services. And I just wanted to take a few minutes and go kind of recap the first quarter of 2023 and then just kind of tell you briefly about kind of what we're looking at going forward for this next quarter. So the first quarter of this year started off real well. In fact, it was the best January for the S&P 500 in 4 years. We closed out last year with a Fed funds rate of 4.25%, and expectations were that the Fed might increase interest rates one more time before it signaled a pause. There were additional expectations by some that we would actually see rate cuts by the second half of this year. GDP for the fourth quarter came in at a positive 2.7% year over year, and inflation has been coming down. This all primed the markets into believing that the Fed could actually pull off a soft landing while taming inflation down toward that 2% target rate. But sometimes what we want is not always reality on the ground, right? And just as I described, the markets were up on a very specific set of expectations. One, that inflation would continue to decline rapidly, that the Fed was near pausing its rate increases, the economy would avoid a recession, and that the Fed would engineer a soft landing, and that job and wage growth would slow down. That's a lot of needles to thread. First, inflation did not cooperate as the rate of decline slowed and began leveling off, signaling that inflation would be more stubborn than we were expecting. And we've been talking about this for months, and in my opinion, the decline in inflation from the peak of last summer is directly correlated to the decline in gas prices that hit record highs last July. As gas prices declined, it costs less to produce and deliver goods. So naturally, some of those savings are passed on to consumers and hence reduced inflation. But that's easy inflation. Other components of inflation remain in place, or they've even gotten worse. Higher labor costs due to work shortages, supply chain hiccups, people getting used to paying more, and demand not slacking at all conspire to keep inflation high. The other factor that worked counter to the Fed pivot narrative was a robust labor market. The Fed wants to decrease demand for goods and services. And how do you do that? You can cure high prices by making prices higher so that it gets so high that people just won't buy them and you have to bring prices down. Or you create an environment where businesses need to lay people off or at least stop new hiring. This in turn would lower overall demand at current levels and force prices to come down. After all, people tend to spend less money when they're unemployed, unfortunately. These factors persisted, and the Fed continued to take a hawkish stance, which in essence said that they would continue increasing rates or keep rates higher for a longer period of time. So that kind of threw the whole rate discussion out the window, and the Fed pause became the new rallying cry instead of a rate cut for the second part of 2023. With that change in the investment wind, we had a pretty rocky February, gave back some of the gains that we had in January, basically as we just kind of limped into March. March started out much the same that February has, with markets still kind of nursing their wounds after being disabused of their narrative by the Fed. But just when we started to regain some equilibrium, the whole Silicon Valley Bank debacle happened. The news hit markets pretty hard. We were already in a pretty delicate place, and a banking or a liquidity crisis is not something that markets wanted to or needed to deal with. As of this recording, the regulators have since stepped in and made all of the SVB depositors whole. It appears that the cap on the FDIC limit of $250,000 insurance is basically waived as well. So troubled banks can once more count on the Fed to bail them out for their poor decisions. The dialogue basically went from higher for longer to a discussion that based on this mini banking crisis, the Fed should immediately pause rate increases. At any rate, the first quarter provided further proof that we're not out of the woods yet, and we're not any closer to any clarity on when this bear market will end. We'll be back with you in 3 months to kind of recap the second quarter again, but we need to see some stabilization in the market in a clear direction. My concern continues to be that the Fed is going to overdo it with interest rate hikes to a point where rather than pausing, it will make things so bad that it'll have to reverse course because it broke something that can't put it back together quickly, and that'll force us into a recession. It does appear that breaking the housing market and almost breaking the banking system in 2008, 2009 really haven't taught the Fed or the Treasury any lessons. So what's next, right? It's almost certain that there's going to be something new that we're going to have to factor in. So what are some of the headwinds that we think we're facing in the second quarter? Well, the first is ongoing inflation, right? We've been talking about inflation for some time, and we're going to still be talking about it for a while longer. And latest inflation numbers came in at 5%, which is progress. Things are declining, but it's still a long way from the 2% target number. Rising interest rates is the second one. We've talked a lot about interest rates over the last year or so, and the Fed has now raised rates 9 times since 2022, and the Fed funds rate currently sits at 4.75% to 5%. It's the first time it's reached 5 since 2006. The forecast is for the Fed funds rate to be between 5.25% and 5.5%, and some are even saying that there's a slim chance it could hit 6%. Number 3 is a potential for recession, right? The biggest concern now is that the Fed is not going to be able to do a soft landing, and they're going to overdo it with the rate hikes. They said they remain focused on bringing down inflation, and that means they need to keep raising rates until unemployment goes up and spending slows. But if they hike rates too high, they could end up bringing in that recession. And of course, the fourth one is just unexpected events, globally or here domestically, can always influence market performance, both for good and for bad. For instance, if the Russia-Ukraine war came to a halt tomorrow, that'd be a great thing for the global economy, and that would push markets up. But if the Fed keeps hiking rates, markets probably aren't going to like that. But either way, we think markets, as a result, your investments, will continue to be kind of on their roller coaster ride this second quarter. We've been focusing more on kind of dividend type of stocks, so that if we do get more of a recession, those dividends can kind of help ease things. Also looking at treasuries to keep markets stable or keep your account stable and get a decent yield on them as well. Until then, until we speak to you again, enjoy the spring. Hope you enjoy the warmer weather. Please reach out to us if you have any questions. As always, we continue to monitor the economy and the markets in your portfolios, and we'll let you know about any changes that should be made if we see something. But thank you, and have a great day.